Okay, I'm recording.
Okay.
So our equipment was debited, which was correct, but our cash was never credited. So our assets were increased correctly, but they weren't decreased, which means our assets were overstated. And then in terms of our liability, accounts payable was increased when it shouldn't have been at all. And so if it was increased, then we overstated that. Oh. And then in terms of net income, none of these accounts, equipment accounts payable and cash, affect our net income. So nothing happens to our net income. Is everyone good with that?
Net income.
I'm sorry?
Which accounts do affect our net income?
Revenue and expenses. Net income has to do with our income statement. So revenue minus expenses equals our net income. Does that answer your question?
Yes.
I have a question. So if we were to do the journal entry way, while we're figuring out the answer, do we just follow like the arrows?
Yeah, I mean, it's really whichever way you want to do it. I think the most effective way is to kind of just like think about what's happening, right? If equipment was like, if you got equipment, right, and you were supposed to pay cash for it, you never paid, like your journal entry never paid out the cash, so you never lowered your assets, right? Which means your assets are overstated. And then in terms of your liability was increased when it never should have been. And so your liability was overstated too. Does that make sense?
Yeah, thank you.
Handout 4 is mainly just testing you if you know your normal balances, which also can correlate with like what's increasing or what's decreasing. So I mean, there's really no proper way to like do overs and unders. It's just if you understand the concepts and
yeah.
So, yeah.
It's really however you want to do it. I think the best way I learn is with journal entries, but if teachers you do it, then whatever works for you, honestly. Is everyone ready for number 2? Yes. I can take that as yes. Okay. Okay, so failed to record the purchase of merchandise inventory on account. So when you purchase merchandise and it's inventory, that's perpetual, right, Jesus? Mm-hmm. Yeah. Okay, so the journal entries, okay, so they didn't do anything, right? So there's nothing to write in red because they just didn't record anything. So the journal entry for that would be a debit to inventory. Jesus, tell me if I'm wrong because I'm blanking out on this. Debit to inventory, and they said that they did it on account. So you would credit accounts payable. Is this right?
I'm looking at the answers, and I think it's saying it's periodic because assets will be no effect. So I'm assuming it would just be purchases and accounts payable.
Yes. Yeah, sorry. I'm wrong. Please excuse me. So it is just using the periodic system. So we're just going to debit purchases and credit accounts payable. So I can't hear anything. Yeah, it's probably your computer, Jean. Try changing it to like your computer audio or something, or maybe leave and come back might work.
Is your audio on, Jean?
Jean,
Can you hear me?
yeah, we can hear you.
Is that yeah?
Yeah.
Or no? Okay. I can't hear shit. Okay. Okay. I'm gonna try to go out, come back.
Okay. So number 2, so our journal entry would be to debit purchases and credit accounts payable. The kind of account that purchases is an expense. So this is going to affect net income, and it's going to lower net income since it's a expense. And then accounts payable is a liability, and when you credit it, it's an increase. And let me show you with T-charts. So gonna debit purchases. Oh, you know what? I just remembered how he did it. It's like assets, liabilities, and net income, right? Okay, so purchases, go over here. And we debit those. And then accounts payable. And we credit that. So if our net income, so let's go with assets first. So neither of these accounts affect assets, so it's going to be nothing for assets. And then in terms of liability, our accounts payable was never increased because this journal entry was never recorded. So if it was never increased, then we're understating liabilities. And then in terms of purchases, if the purchases were never recorded and the expense was never recorded, then the net income was never lowered, which means our net income was overstated. Does everyone get that? Any questions? No? Okay, I'm gonna move on. So, number 3. Cash received from a customer in payment of its existing account is recorded as if the receipt were recorded for current period sale. Okay, so basically what this is saying is that, okay, let's write down what they did wrong first. So they recorded it as a debit to cash and a credit to sales revenue, because they say here that they recorded it as if the receipt were for a current period sale, when actually they got cash, which is correct, but the payment of its existing account means that, let's say last month I made a sale, but I debited my AR instead of cash, and now that customer is coming back the following month and paying me cash. So I have to debit my cash, but now lower my AR. So in terms of arrows, income goes up because revenue increases your net income, assets increase. And then in terms of AR crediting it, it's an asset, but by crediting it, you lower it. Oh, shoot. I'm gonna move this to the next page. Okay, so now for T-charts, we'll do cash. And then sales revenue. So even though they debited it here, they also they did that correctly, right? So like this is good. That makes sense. But they should have credited AR, and they should have credited, no, sorry. But they recorded it as sales revenue. So in terms of assets, our assets were increased, which was correct, but our AR wasn't lowered, so our assets are overstated. And then there's no liability in this case, so nothing happens to our liability. And then our sales revenue was credited, which means it increased net income when it shouldn't have been, because that was already done in the previous period. So our net income is overstated. Any questions?
Why is assets overstated again?
Because when they should have done this, right? They should have lowered their AR, and accounts receivable is an asset and they never credited it. So that's why assets are overstated, because the cash was increased, but the AR was never lowered.
What about sales revenue?
Sales revenue was wrong. They shouldn't have recorded sales revenue. So you overstate sales revenue, or you overstate net income because your sales revenue was credited when it shouldn't have been.
And sales revenue has a normal balance of debit?
Credit.
Credit.
So like, does that make sense?
Yeah.
Okay. Can I move on?
Yes.
4. Okay, so number 4, they recorded a credit sale as a debit to cash and a credit to sales. Can anyone tell me what they did wrong?
Let me ask like some of you guys one thing. Like, what's a credit sale? Like, what would that journal entry look like?
The accounts receivable is overstated, so they shouldn't have done accounts receivable. They should have increased cash.
Well, first, no. First, tell me, okay, so what's the journal entry that they did wrong?
Oh yeah, they did cash instead of accounts receivable, so they shouldn't have done cash. They shouldn't have debited cash.
Tell me what the journal entry is that I should be writing in red.
So debit cash,
Okay.
and sales revenue credit.
Okay, so now what should I be writing that they should have done?
They should have accounts receivable debit, and then sales revenue credit.
Okay, good. So when we have a journal entry, or like when we have a problem like this, right? This is an asset that increases, and this is net income that increases, and this is also an asset that increases, and this is net income that increases. So when you see something like this, yes, they put it in the wrong account, but in terms of your overall assets, nothing really happens to it, right? Because it was increased somehow. So there's no effect on any of them. Does that make sense?
Mm-hmm.
Can you explain that again a bit?
So so if you look here, right, cash and AR are both assets, and sales revenue, and these are the same accounts, right? And the answer that you're looking for, this is assets, this is liabilities, and this is net income. It's not asking you about the specific accounts like it is in the trial balance, right? So in terms of your assets, just in general, your total assets, there's no effect on them, because even if, okay, so let's say your total assets is $10,000, right? And you debited cash for 1,000 when you should have just debited AR for 1,000. If I debit cash for 1,000, that increases my total assets to 11. But then if I fix my journal entry and, credit cash and debit AR and fix that, my AR still increases my assets by 1,000 and still makes my total assets 11. So there's no effect on the mistake that they made. Does that make sense?
Yeah.
Okay.
Thank you.
Let me do it with teachers. So number 5. So number 5 says the receipt of money from a bank loan is recorded as a debit to cash and a credit to sales. Okay, can someone help me with this one? I want to make this really interactive, guys, because I can do all these for you, and you can understand them, but actually going through the whole thought process of it and trying to do it yourself is going to be really helpful. So
May I try?
yeah, go ahead. So tell me what I should be writing in red.
So cash first,
So debit to cash.
then sales revenue.
Tell me what to debit and credit.
Okay.
And so what should they have done?
They should have done loan payable, debit loans payable, or
Why do you debit loans payable?
never mind.
Do we credit
We
loan
increase
pay?
our assets. So we have to increase our assets. So we got like cash or
You got cash, right? You took out a loan, so you got cash for it, which is fine, but it's not revenue. It's
we have to
liability that you now have. So
we have to increase liability.
you do that, right? So this increases your assets, and this increases your net income. This increases your assets, and this increases your liability. So let's do this in T-chart. So cash. Let me know if I'm doing the T-charts the right way, because I don't usually do them like this. So if you guys want me to do it another way, just let me know. So, oh, this should be down, right? Should be down here. And then sales revenue. So, in terms of our assets, there's no effect because they debited cash correctly, right? But then in terms of our liability, they never increased their what?
Did they understate liabilities?
Yes, they understated their liabilities because they should have increased their liability by crediting the loans payable, but they never did. So your liabilities are understated. And then in terms of net income, they increased their sales revenue when they shouldn't have. So their sales revenue is going to be, or their net income is going to be overstated. Is everyone good?
Can we do the very first example?
I'm sorry?
Can we do the very first example?
Like,
For the cash sale.
yeah, sure. Can I just like tell you, or do you want me to write it down?
You can tell.
Okay, so if they failed to record a cash sale, they just failed to debit cash and credit sales revenue. So if they didn't debit cash, which increases your assets, you understated your assets. And then there's no liability in this case because you're just debiting cash and crediting sales revenue.
Mm-hmm.
So no effect on liabilities. And then you should have credited your sales revenue, which increases your net income. So your net income is understated. So it should be UNU.
Thanks.
Mm-hmm. Is everyone good on number 5?
I have a general question.
Mm-hmm.
What accounts tend to affect, not accounts, but transactions tend to affect net income?
So,
because one thing you said was revenue.
Expenses.
yeah. So net income is what happens on your income statement, right? So revenue minus expenses equals your net income. I mean, yeah, revenue minus all your expenses is your net income, right? So revenue has a normal credit balance. So if you're crediting revenue, then you're increasing your net income. and if you are debiting and expenses have a normal debit balance, so if you're debiting your expenses, then you're lowering your net income because expenses lower your income.
Yeah.
Thank you.
However, some accounts don't like specifically say expenses. You have to recognize them. For example, purchases under the periodic system, and their corresponding contract accounts like purchases RDA. So it's really a matter of like just analyzing them.
Okay, number 6. Failed to record depreciation at the end of the current period. Does someone want to help me with this one? It's really going to help you guys to do it yourself and like think out loud. Trust
If you
me.
guys want to talk, just shoot us a chat.
Yeah, just put it in the chat if you don't want to do it. Jean, do you want to do this one?
Yeah, I can try.
Okay.
So
So did they make first think, did they make any journal entry that was incorrect, or did they just omit something?
they omitted something.
Okay, so what did they not do?
Depreciation expense.
So tell me what to debit and tell me what to credit.
Depreciation at the end. I just know depreciation expense.
So the journal entry for depreciation is you expense your depreciation, so you debit your depreciation expense, right? And then what do you credit?
That's what I can't figure out. I don't know which account we credit when.
Is it accumulated depreciation?
Yes. So you have your accumulated depreciation. And depreciation expense affects our assets, our liabilities, or our net income. Which one?
Is it liabilities and net income?
Why would it be your liabilities?
Net income.
Net income. And does it lower it or increase it? It's an expense, right? So it's going to lower your net income. And then accumulated depreciation affects your assets, but accumulated depreciation is a contra asset, which means it has a normal credit balance, which lowers your assets.
Yeah, so depreciation is associated with equipment. Obviously, equipment is an asset, and over time, it's going to start depreciation. So it's kind of like losing its value. So we use the account accumulated depreciation to consider those that value going down. Since it's like bringing down your assets, we call it those accounts contra accounts. So in the way they act like opposites. So since normally assets have a normal debit balance and they're increasing, this accumulated depreciation is a contra account, so it's lowering your assets. Does that make sense?
So in terms of the answer, this journal entry was never done, right? So in terms of our assets were never lowered, which means our assets are overstated. In terms of liability, nothing happens to liability. And in terms of our net income, our expense was never recorded, which means our net income was overstated. Does that make sense, everyone?
Can you explain why the depreciation expense was affecting net income?
Yeah, because expenses lower your net income.
Okay, thank you.
Is the T account for accumulated depreciation correct?
Yeah, because accumulated depreciation, you credit it. It has a normal credit balance. It's a contra asset, not an asset. Okay. Let's move on.
I can do 7, Ariana.
Okay.
Could you just draw like
I'll just follow what you're saying and I'll write.
Okay, so let me just read the question. So they failed to record an AGE. Salaries are paid every Friday for a 5-day work week. The normal weekly payroll is $40,000. The year end falls on Tuesday this year. So there are 4 main adjusting journal entries. It's accrued revenue, deferred revenue, accrued expense, and deferred expense. That's more of a handout 2 question, but basically this is an accrued expense. So could you draw like 5 days? Like Monday, Tuesday, Wednesday, Thursday, Friday. So day 1 is Monday and day 5 is Friday. They're trying to see how much of like salaries they owe to their employees before the year ends. So in the question it says the year end falls on a Tuesday. Could you like draw a line between Tuesday and Wednesday? Yes, thank you. So since their payroll's 5 days and the year falls on Tuesday, they only have to account for Monday and Tuesday. So what I did, I just took 2 divided by 5 times the payroll amount, which is $40,000. Does everyone see why?
Yes.
Okay. So this is my adjusting amount. And the actual entry for this adjusting journal entry, it's going to be salaries expense and salaries payable. So can someone tell me which accounts are being affected?
Net income is affected and liabilities.
So since we don't have any assets here, assets are automatically no effect. Since they completely forgot to record this entry, our liabilities will be understated and our net income will be overstated.
Everyone good on that one?
Can you go over the letters again? The why
Which one?
why it's not affected, understated, or overstated. I was writing, so
Okay, so we don't see an asset in this journal entry, so assets are no effect. Since they completely forgot to record this journal entry, our salaries expense will be bringing our net income down, and our salaries payable will be bringing our liabilities up. Since we forgot about it, our liabilities will be understated, and our net income will be overstated.
Number 8? You want to do number 8?
No, it's a rent expense.
Okay.
You can do that one.
So they failed to
I'll do 9.
So they failed to record an adjusting journal entry when examining the rent expense account. The controller finds a $4,800 advance payment for 3 months' rent. The payment was made on November 1st. So this one's kind of confusing, right? Because if it's prepaid rent, why are they expensing all of it when they got the money? So this is what Professor calls the unusual adjusting journal entry. Because originally, when they got the $4,800, they should have debited prepaid rent and credited, cash. Yeah. They should have debited prepaid rent and credited cash. But what they did was they debited rent expense, and debited cash. So they expensed all of it in the first month when they should have accrued the expense each month, right? By lowering their prepaid rent. So now, okay, so on November 1st, that's when they expensed all of it, but they bought it for 3 months. And so at the end of the year, they have expensed 3 months when they should have only expensed 2 months. So we have to basically what Professor calls unexpensing it, right? So they failed to record a adjusting journal entry, so there's no mistake that they necessarily made. We're just going to fix it. So now it's December 31st, and they have a month left of rent that they already paid for, but they never increased their prepaid rent. So what you have to do is you have to debit your prepaid rent and credit your rent expense, because on December 31st, before this adjusting journal entry, you've expensed 3 months when you should have only expensed 2 months. So you're expensing too much from that year, if that makes sense. So in terms of accounts, this increases your assets. And since expenses have a normal debit balance and you're crediting it, you're unexpensing it. So this is going to increase your net income. So in terms of T-charts, you have prepaid rent. That increases, and then rent expense. So now, if our prepaid rent should have been increased and our assets should have been increased, and we're going to say that they're over or understated. Nothing happens to liabilities in this case, because neither of these accounts affect liability. Then in terms of expense, if you're unexpensing it, kind of think of it as revenue. You're kind of putting money back into net income. So your net income is going to be understated. I know this one's really confusing. So does anyone have any questions?
Can you just go over one more time for number 8?
Yeah. So they failed to record an adjusting journal entry. And when they looked at the rent expense account, they saw that they expensed $4,800 on November 1st when they purchased 3 months of prepaid rent. They should have debited prepaid rent for $4,800 and credited cash, but they expensed all of it in that first month when they should have expensed $1,600 each month after they had debited their prepaid rent. So they should have debited prepaid rent, credited cash on November 1st, and then on November 30th, they should have debited their rent expense and credited their prepaid rent each month, right? So they should have expensed it each month. But what they did was they just expensed all of it in that first month. So now it's December 31st, and they've only used 2 months of the 3 months that they paid for. So now I have to debit my prepaid rent, which I should have done in the first place, and lower the expense because I haven't used that month yet.
Right.
Okay, and it's annex.
Does that make sense?
Yeah, it makes sense. Thank you.
Mm-hmm. Is this going to do this one?
9?
Yeah.
Sorry, so Patrick just texted me. Okay. So again, with this one, they failed to record an AGE. There is $500 of supplies left in the storeroom. At the beginning of the year, there were no office supplies. During the year, $3,500 of office supplies was purchased. The cool thing about overs and unders, unlike trial balance errors, is you don't really need amounts unless stated. So in this case, all the numbers you see is in a way to just like throw you off because you just need the actual adjusting journal entry. So since they use up supplies throughout the year, expensing their supplies. So it will be a debit to supplies expense and a credit to supplies.
Because if you had bought 3,500 and ended up with 500 at the end of the period, then obviously you used 3,000 of it. So you have to lower that by expensing it.
Yeah. So expenses affect your net income and supplies affects your assets. That's going down, that's going down.
So if your assets should have been lowered, then your assets were overstated and nothing happens to your liabilities. And if your supply should have been expensed, then your net income is overstated because you didn't lower it yet by expensing it. Everyone good on this one?
You mind explaining it again?
Yeah, so at the end of the year, they had $500 of worth of office supplies, right? But during the year, they didn't have any. Here, let me show you something. So you know when you are doing a income statement and you want to find your cost of goods sold, you have your beginning balance plus your purchases minus your ending equals your cost of goods available, right? Your cost of goods sold, right? So think of it in the same way. They say there's no beginning balance. They didn't have anything in the beginning of the year, but they purchased during the year 3,500. But at the end of the year, they had 500. So their cost of goods sold, what they used was $3,000 of it. And so when you use up supplies, you have to expense them because originally when they purchased them, when they purchased that 3,500, they debited supplies and they credited cash. But now they don't have $3,500 worth of supplies anymore. They only have 500. So you have to debit your supplies expense for 3,000 and credit your supplies for 3,000.
So because you credit it. Okay. So, okay. Yeah, I got it.
Okay, number 10. Failed to record AGE. The company received an order in May with a $13,000 advance payment, which was credited to unearned revenue. In November, the last of the order was shipped to the customer. So this is one of those for adjusting journal entries that Jesus was talking about. So this is deferred revenue, right? They got $13,000 in May, which they say is an advance payment. So they didn't earn any of that $13,000 when they got cash. So what they did was they debited cash and they credited unearned revenue for $13,000. Now in November, they shipped all of it to the customer, and so they earned all of that revenue. So so now they need to lower their liability and then finally recognize their revenue. So the journal entry is going to be a debit to unearned revenue and a credit to revenue. And so this lowers your liability because you're debiting it, and this increases your net income. Let me do it in T-charts. So nothing happens to our assets because neither of these accounts affect our assets. Our liability should have been lowered and it wasn't. So our liabilities were overstated. And then in terms of our revenue, it should have been increased and it wasn't. So it's understated. Everyone get that one? Number 11. The company has a $20,000 9-month 12% note payable outstanding at the end of the year. The note was issued on October 1st. The interest is to be paid when the note is paid. So they already did their original entry of getting the cash and increasing their liability for the note payable, right? So this is just a AGE that they didn't record. And the AGE that they didn't record is the interest that they're accruing that needs to be paid. So can someone tell me how I can find the interest? How do I find the amount?
20,000 times 9/12 times the percentage.
Why is it 9/12?
Because of 6 months.
I'm sorry? So whenever it says a 9-month pay note, don't pay attention to that. The note was issued on October 1st, and this is December 31st, and they need to figure out how much interest they've accrued in those 3 months. So it's actually going to be 3 out of 12 because they've accrued interest for 3 months. And it's not out of 9 because the interest rate, the 12%, is always based off of 1 year. It doesn't matter how long the note is for. The amount of the note is just gonna tell you when you have to pay it back. So it's 20,000 times 3 months out of 12 because you have October, November, December, and it's at a 12% interest rate, which is
600.
600. So can someone, okay, so I've accrued $600 worth of interest that I need to pay, right? But the interest is to be paid when the note is paid. So what is my journal entry?
With interest expense and interest payable.
Good. And so expenses affect net income, they lower them, and your payables increase your liabilities. So now in terms of the answer, nothing affects our assets. And then our liabilities should have been increased, which it wasn't. So our liabilities are understated. And our expenses, or the expense was never recorded, so our net income was overstated. Everyone good on this one?
Yeah, I am.
I just jotted down some notes in the chat about the differences between like deferred revenue, deferred expense. I know it's more of a handout too, but it's just a general idea. If you guys can please study these, because on my final, he didn't say if it was like a salaries expense, or he didn't say if it was a prepaid. He just said they forgot to record a deferred expense. So it was automatic that you guys had to new the accounts. So I would just spend some time studying handout 2. And I believe Raymond is studying henna too, and he's awesome too.
Does anyone have any questions in terms of this handout? You guys want to move on to the extra? Okay, I'm going to take that as a yes. How many people are in here? Oh, a lot.
It's
Okay.
14.
Wow. Okay. Should I go straight to like the number one, the number two? Yeah. Okay.
Well, I mean, does anybody have any questions on specific problems on the extra practices?
I have a few specific ones, but if you guys still want to go from the beginning for the others, I don't mind.
It's up to you, Jesus.
Yeah, I mean, it's up to you guys too, because you guys can also jump back and forth between the calls. I just want to be courteous of your time. But if like everyone agrees, we can just go over at once, and that's fine.
We could start from beginning.
Okay,
It's okay.
Guys, let me know if my screen freezes because I'm not looking at it. Okay. So number one. Alpha purchased equipment for cash but did not record it, nor was the AJE recorded for the depreciation on the equipment. Okay, I think it'll be really helpful for some of you guys to tell me what to do. So can someone do this problem for me? Tell me what to do.
So apparently Alpha purchased equipment which would be debit equipment and credit cash, but they didn't record that.
Oh, yeah. Sorry. They did not record that. So, debit.
Nor did they did the depreciation on the equipment.
And what's the journal entry for that?
For that
Depreciation expense
Depreciation.
and accumulated depreciation.
Okay. So it would be depreciation expense and accumulated depreciation.
So, just a side note, because they didn't do either of these journal entries, I think it's really beneficial in a problem like this to use numbers because you have assets that are increasing and assets that are decreasing at different amounts because you're not going to accumulate all the depreciation in the first year, right? So I think it's really beneficial to use numbers in this case. So I'm going to just make numbers up, which you guys should really be doing in a case like this. So let's say they purchased the equipment for $1,000 and they depreciated over 5 years. So they're only using the straight line method. So they're only depreciating $200 in the first year. So my assets are increasing by 1,000, but they're only decreasing by 200. So you have to make sure that you're paying attention to something like that. And you can make these numbers up, but just make sure that your accumulated depreciation, which I wrote expense, is lower than the equipment that you're purchasing in the same year. Does that make sense?
Yes.
Okay, what's next, Sanjay?
So because we didn't record it, we didn't record the fact that we did that, equipment would be lowered for assets. And so that wouldn't make any difference because
So when you purchased equipment and you used cash for it, your assets going up and your assets going down at the same rate because you're purchasing equipment. They're both assets, right? So it goes up and then it goes right back down, same amount, right? But then in terms of accumulated depreciation, that lowers your assets.
Right.
Assets are actually overstated because you didn't accumulate that depreciation. And then in terms of liability, nothing happens to liability. And then in terms of net income, the expense was never recorded. So our net income is going to be overstated. Does that make sense?
Can you explain why the assets are overstated again?
Yeah, because so we have three things in this problem that are affecting our assets. We have our equipment, our cash, and our accumulated depreciation. When we get our equipment, we increase our assets by 1,000. And then we pay cash for it, which decreases it right back down to the same amount that it was. Our assets are just moving over to a different account. And so there's no effect on that in that problem. But then when it comes to accumulated depreciation, which was never recorded, that lowers your assets. Does that make sense?
Yeah, thanks.
Let me just do this. Equipment. So when I do, no, I'll just write numbers, never mind. So does everyone understand how I'm using the numbers too? It's really important to use it in a problem like this. We'll take that as a yes. Okay, number 2. Alpha received cash in advance from a customer for services to be performed in the future, but failed to record the transaction. They also failed to record an AGE by year end. Some of the services have not been performed. Does anyone want to do this problem?
Cash in advance.
And I'm going to tell you right now that you should be using numbers in a problem like this too.
Let me call someone out if no one wants to talk.
Call them out.
We stayed
In.
Okay, purchase cash in advance.
Wait, what?
I think Stanja's just reading to herself.
Sorry.
what they also like, because it says that they didn't
So they got cash, right?
record
Okay. Let's give an example. I provide services for tutoring. Jesus pays me $1,000 to tutor him through the whole entire week. And so on Monday, beginning of Monday, I haven't tutored him at all yet. And so I have this liability that I owe him $1,000 worth of tutoring services. But then now it's Wednesday, and I've tutored him for 3 days, so $200 a day. And so I've earned $600 worth of those tutoring services, but I still owe him $400 of it. That's what this is saying.
So is it unearned revenues $200 for the difference that the 2 different days you didn't perform service, and revenue or service revenue?
So they didn't record anything.
Yeah, so they aren't they recording the AGE, which is unearned revenue of balance?
Hold on. You need to talk about the original journal entry first. So what's the original?
Okay. So the original journal entry would be unearned revenue and revenue.
No.
cash and unearned revenue.
Cash and unearned revenue.
Yes. And then, so I'm going to say it's $1,000. And then now I've earned 600 of it.
So it's debit unearned revenue. And credit revenue.
Yeah, because I've earned it now. So now I can record it as revenue. Because unearned revenue is not affecting your net income. It's a liability until you've performed those services. It's not recorded as any kind of revenue, even though it says unearned revenue. It's a liability. So cash. So actually I should be using numbers. So 1,000 1,600. So my balance here is 400. And then my revenue is 600. So in terms of accounts, when you debit cash, it increases your assets. This increases your liability. This lowers your liability when you debit it, and this increases your net income. So our cash was never recorded. Sorry, our cash was never recorded, which means our assets were understated. In terms of our liability, it was never increased by 1,000 and then lowered by 600. So the balance in unearned revenue still $400 of a credit balance, which means our liabilities were understated. Then in terms of revenue, it was never increased by that 600, so it's also understated.
Damn.
Does anyone have any questions on this one?
No.
See why it's important to use numbers though in this case? Maybe. Okay. Number 3.
I can do this one, yeah.
Yeah. Okay.
So Alpha failed to record a refund of cash to a customer for the return of a merchandise sold during the year using the periodic inventory system. All right, could someone tell me which account I'm gonna use if I'm returning merchandise if it's under the periodic system?
Purchases?
If I'm returning something.
Is it sales return?
Oh, wait, I'm sorry. It's a refund of cash to a customer. So the customer is returning their merchandise to my firm. So which account will I use?
Is it purchase returns and allowance?
Yes. And it's for cash. So you will debit returns and returns and allowances and then credit cash. Whoa, Ariana, it's sales.
Sorry. Wait, what?
We're doing 3, right?
Sorry, I'm not paying attention.
Oh, it's it's sales RNA and cash. Okay. Now, can someone tell me which accounts will be affected with this? I'll give you a hint. Sales RNA is a contra account.
Is it a liability?
No. So if our sales are a revenue account and they increase net income, then if I'm giving some merchandise back for something that someone bought, I have to lower my sales. So it's a cost of sales account, which means it lowers my net income. And then what kind of account is cash?
Asset?
Assets. All right. Yeah. Do we see a liability here?
No.
No, so it's liabilities are no effect automatically. What about my assets?
Cash is affected
How so?
because it goes down because you pay back the money that they returned. You pay them the money, so the cash goes that you have went down.
So was our assets
And
overstated or understated?
So your cash is
If we forgot to give out the cash,
it's overstated. It overstated.
it's overstated. What about my net income?
So your net income went down and it is understated.
Why is it understated?
Because you returned back some of the sales, the goods that you had, and because you return it, it affects your cost of goods.
So this is under the periodic system. So we don't have cost of goods sold until we close out the accounts at the end of the year. So since we returned merchandise, we have to omit some of that revenue we made from our sales account. So if we forgot to remove some sales, our net income will be overstated.
So like if I made a sale of $1,000, but then I returned back to the purchaser $400 of it, my sale should only be $600.
Could you go over that part again, please?
Huh?
Could you repeat?
Yeah, so if I made a sale of $1,000, okay, Jesus purchased $1,000 worth of stuff from me, but now he's like, I only want 600 of it now. So now I have to give him back $400 worth, and he gives me back the stuff that I purchased. But this is under the periodic system, so the stuff that he gave back doesn't matter right now. So now I'm giving him $400 back, and now I have to lower my sales because I didn't make a sale of 1,000. I only made it for 600 now. And so if I recorded my original entry as $1,000 to sales, it's really only 600. So my net income was overstated by $400.
Okay. Got you.
Is
Thanks.
everyone following? Yes.
Huh?
We
I said, is
we-
everyone following?
I'm
paid-
following. I'm
Okay.
following.
Silence is a yes. Okay, number 4. So,
I can do this one too.
okay.
So Alpha issued common stock to an investor for cash. However, the transaction was I can never pronounce that.
I just say they did it wrong.
They erroneously recorded it as a cash sale. So what did they do wrong?
So they debit cash and credit sales?
Yes. And they should have debit cash and credit common.
Does common stock affect assets, liabilities, or net income?
No.
Good.
I don't think it.
No.
I don't think it affects it.
Common stock is an equity, account, but it
right?
doesn't affect net income.
Right.
So
In this scenario, they recognize cash correctly by increasing it. So my assets are no effect. And since we don't have any liabilities, that's also no effect. However, they recognize sales incorrectly, so it will be overstated. Yes. Does that make sense?
I have a question.
Yeah, what's up?
You said that common stock does that affect net income or no?
It's part of the same account as net income, which is the equity account, but it's not associated with net income.
So it wouldn't be.
doesn't affect anything.
Yeah, it doesn't affect anything. However, since we did recognize some sales incorrectly, our net income will be overstated.
Okay, I thought it affected net income and that way the sales and the common stock balance, but since it
No. Yeah.
Okay. Jesus, don't you like these ones?
5?
Yeah.
Oh, I hate these.
Okay.
Okay.
Alpha merchandise.
Alpha sold merchandise to Beta on credit with terms FOB destination. As of December 31st, the merchandise had not yet been received by Beta. Alpha recorded the sale and counted the merchandise in ending inventory under the periodic system. Is everyone good with the terms FOB destination, FOB shipping point?
Destination is, it can only be recorded once they receive it, the people who purchased it, and shipping point once it leaves the seller.
Mm-hmm.
Ariana, could you write my little trick? Like S can go with S.
Tell me how to write it because I don't.
So the way I remember these terms is just S can go with S. So shipping point is the buyer.
Oh. Wait, what do you want me to write?
So shipping point, buyer. And destination seller.
When you say destination seller? Sorry,
Yeah.
buyer and shipping point seller?
Wait, what?
You know,
I'm asking, wouldn't it be shipping point seller and destination buyer?
What you're trying to say is a shipping point, the buyer pays for it, and the destination is the seller pay for it.
yeah.
Yeah, they're responsible for the freight.
Okay, gotcha.
So in this scenario, who is the seller and who is the buyer?
Alpha is the seller, beta is the buyer.
Okay, good. And they're under the destination terms. So that means alpha is responsible for the freight. So, wait, what?
Which means they keep it in their inventory until the buyer receives it. And the buyer doesn't record it until they actually get it.
So since the merchandise had not been received by beta, which is the buyer, alpha recorded the sale and counted the merchandise in ending inventory. So should have they recorded the transaction?
No.
No, right? What would the transaction look like?
AR debited and sales credited.
Can you tell everyone why you said AR instead of cash?
Because it's on credit.
Good. But should they have counted it in their merchandise?
Not yet.
This is
Because
alpha though.
Isn't it saying alpha shouldn't yet have recorded the AR in the sale?
Yeah, so that's correct. They shouldn't have recorded the sale, but should they have counted it in their ending inventory?
Good question.
Yeah, because it's theirs until it reaches the destination. So they should have recorded it in their inventory. So that part was correct.
Yeah. However, the transaction shouldn't even be there because beta hasn't received the merchandise yet. So they can't really recognize the sale yet. So AR is an asset which is increasing. Sales are net income, which is also increasing. So both of them are what? Understated or overstated?
Overstated.
Good.
That's the answer.
Yeah. Is everyone good with this? Yes? No? Maybe so.
Okay, number 6. Alpha paid a dividend to shareholders to satisfy dividends payable, but recorded it as cash to satisfy an account payable. Can someone other than Stangia or Jean do this one? Maybe. No? Okay. So they paid a dividend to a shareholder to satisfy a dividend payable. So there, can anyone tell me what the original journal entry is for, what's the word I'm looking for?
They credited accounts payable.
I'm sorry.
They debited accounts payable. And then,
Oh, you're telling me what they did wrong?
yeah,
So what did they do?
they debited accounts payable.
And
They credited cash.
what should they have done?
So they paid dividends. So they have to debit dividends payable.
Mm-hmm.
Do they have to credit cash?
Mm-hmm. So this is a liability that goes down because you debit it, and this is an asset that goes down. This is also a liability that goes down, and this is also an asset that goes down. So they did everything correctly, except they put it in the wrong payable account, right?
Mhm.
So nothing is affected because assets were increased or decreased correctly. Cash was decreased. Liabilities were decreased just in the wrong account, and then nothing happened to net income. Cash. Everyone good on this one? Okay. Number 7, Alpha recorded an AGE for interest on a note payable instead of the correct AGE for interest on a note receivable. Interest won't be received by Alpha until next year. So there's two kinds of notes, right? There's a note receivable and a note payable. It's either you borrow money or you give money. In this case, they recorded it as if they owed money to a note, but really they gave a note and they're receiving interest on it. So what they did wrong was they recorded an expense with a payable saying that they owed interest on a note that they got, but really they gave the note. And so they should be receiving interest and recording that as revenue. They're not paying anything, they're earning this money. So this lowers your net income because it's an expense. This increases your liability because it's a payable. Receivable increases your assets, and a revenue increases your net income. So let's look at assets first. Our assets were never increased because of this receivable. So our assets are going to be understated. In terms of our liability, it was increased when it shouldn't have been. So it's overstated. And then our net income was lowered by the expense when it really should have been increased by the revenue. So it's understated. This one's a little confusing. Does anyone have any questions?
Can you explain the liability part again?
Yes. Just like why it's overstated?
Yeah.
So they credited payables when they shouldn't have recorded a payable at all. And so they increased their liability when they shouldn't have. That's why they overstated it. They don't owe interest. They're getting interest. They don't owe anything. So they shouldn't be recording any kind of liability. Does that make sense?
Yeah.
Okay.
Why is net income understated?
Because they expensed, so in the interest expense, that lowers your net income, right? But they're not expensing anything. They're earning money on interest that they're getting. And so they're lowering their interest when they're lowering their net income by expensing it when they should have increased it with revenue. So if it was, let's say net income was $1,000 and they expensed it by 200 when they should have increased it by 200. It's 800 when it should be 1,200.
Okay, that makes sense.
So Everyone good on that one? Okay. Number 8. Alpha recorded cash received in advance from a customer for services to be performed in the future as a debit to cash and a credit to service revenue. Alpha also failed to record an AGE at year-end for half the services performed. Okay, can someone help me with this one?
So they debited cash. Well, they should have. They should have debited cash and credited unearned revenue, but instead they debited cash and credited service revenue.
So, yes, you're correct. They totally should have credited unearned revenue, but we don't have to fix that. It just makes it really difficult. So we're just going to leave that as is, and we're going to do an unusual adjusting journal entry. So what's the journal entry, the adjusting journal entry that I should be doing?
Unearned revenue and service revenue?
No. Why are you increasing your revenue when they've already increased it by the full amount? So at the beginning, when they got all the money, they debited all of it as revenue, right? But now it's the end of the year and they've only earned half of it. So right now my balances are, I have all the cash, which is fine, but my balance in revenue is $5,000 when it really should be $3,000. So what's my journal entry?
Should it be the other way around then? To debit service revenue and then credit unearned revenue?
Yeah, I have to increase my liability because I haven't earned some of it yet. So I have to do that. Does everyone understand that? Is there like an owl in your garage or something?
No, why?
Because I hear like a.
I think it's mine. It's
You have an owl?
no next door.
Oh my god, that's crazy.
It should be increasing their liability and lowering their revenue. Okay, so when you debit revenue, it lowers your net income because it has a normal credit balance. And then when you credit unearned revenue, it increases your liability. So in terms of the answer, nothing happens to our assets in this case. And then in terms of liability, it was understated because you haven't increased your liability yet. And then in terms of net income, it's overstated because they haven't debited their revenue yet. Does that make sense? Does everyone understand the journal entry for this? Okay.
Thank you.
Thank you for the response. Okay. Number 9. Alpha recorded the prepayment of 1 year rent as a debit to rent expense and credit to accounts payable. Alpha failed to record an adjusting journal entry at the end of the year when there were still 2 months of rent remaining in a lease. There's a lot of things going on with this one. Can someone help me out?
Let's start off with the incorrect journal entry first.
Yes.
So what was it that they did wrong?
Rent expense and accounts payable.
So the rent expense is fine. We're just going to fix it with the adjusting journal entry.
Yeah.
But
Prepaid rent is an asset, not.
yeah, prepaid rent is an asset, but we're not going to fix it with that. The issue is the accounts payable. Because why are you recording all this prepaid rent if you haven't paid it yet. You can't do it. You always have to pay with cash.
It's like saying you're paying your rent with a credit card. It doesn't really make sense.
Yeah, you can't do that. You can't do that one. So they did this. When I guess they should have done this, right? Because it's going to get too confusing if we try to do the prepaid rent and everything. Cash. Now let's talk about the adjustment journal entry. So now, okay, so I'm going to use numbers again because it's going to help me. They paid 1 year rent and they have 2 months left remaining on the lease. So let's say they pay $1,000 a month. So they paid $12,000 for it. And now they have 2 months left. So now they have to increase their prepaid rent and unexpense some of that rent expense by $2,000 because they have 2 months left remaining on the lease. Does that make sense? Everyone?
Why did you debit rent, prepaid rent?
Because they never did that in the first place, and it's the end of the year, and they still have.
Their asset, they have it too expensive later.
I'm sorry.
It's like they're gonna expense it later, like next year.
No, they already expensed all of it by debiting the.
So there's $10,000 remaining.
So now there's $2,000 remaining, and now they have to increase their assets because they've paid for 2 months of rent and they don't have that in their assets right now. Does that make sense?
Mm-hmm.
Was that a yes?
Kinda.
So it's like one of those unusual adjustment journal entries because what they should have done in the first place is they should have debited prepaid rent and credited cash. And then each month they should have done adjusting journal entry for debiting rent expense and now lowering their prepaid rent because they're lowering their asset because they're using some of that rent. But they expensed all of it in the first place, which is fine. We'll just do an unusual adjusting journal entry at the end. So now, since they've already expensed all of it, there's no lowering of your assets. You haven't even increased your assets because you just expensed all of it in the first place. So now it's the end of the year and you have 2 months rent left. Now you have to unexpense that because now you're lowering too much from your net income. And now you have to put something in your assets because you've paid for it already, right? So now you have to increase your assets by debiting prepaid rent and then unexpensing that 2 months of rent expense. Does that help?
Yeah.
Okay. Cool. So now let's talk about what kind of accounts. So rent expense lowers net income. This increases your liabilities, lowers your net income, lowers your assets, increases your assets, and increases your net income. Let's do the T-charts for this. So cash. Okay, so for cash, they should have debited 12,000 and they didn't. Prepaid rent, they should have, sorry, I said debited, I meant credited. they should have debited for 2,000. AP, they should not have credited at all for 12,000. And then rent expense, they debited it for 12 and then credited it for 12, which is fine. So this is fine. But now they have to credit it for 2, and now our balance is 10. So let's talk about assets first. They never lowered their assets by 12 and never increased it by 2. And so net should have been lowered by 10, which means our assets are overstated. In terms of liability,
Overstated too.
yes, because our liability was increased when it shouldn't have been. And then in terms of rent expense, oh, okay, I'm sorry about this. This is why this is confusing. This is wrong. So they, so since they did this part correctly, the debiting of the rent expense, that cancels it out, right? So this makes it 0. And so now they need to unexpense it by 2,000. So our net income is overstated because they have to unexpense it by, no, understated, sorry, right? Wait, hold on. If our rent expense was too much, we have to take some of our expenses away, which increases our net income. So it's understated. Is that correct? Is it OOU?
Understated.
Yeah, it's OOU.
Does that make sense? Why the 12,000
Can you
came
repeat
out?
the last part again?
Huh?
Can you repeat the last part again?
Yeah, so the debiting of the rent expense was fine. So this 12,000 and this 12,000 cancel each other out. So now in our rent expense account, we have 2,000 that needs to be credited. And when you unexpense, when you credit an expense, think of it as a revenue. You're taking away some of your expenses, which increases your net income. So like if I had $10,000 in my net income and I decreased it by 5,000, right? My balance is 5,000. And this is my revenue, and this is my expense, and this is my net income. But now, out of this 5,000, I need to take away $2,000 of it. So now, I'm only taking away 3,000. So my net income is going to be 7. So that's why this compared to this is understated. Everyone good on this one? Okay. Number 10. Alpha failed to record the return of inventory to the manufacturer for a credit using the periodic inventory system. Can someone tell me what the accounts I should be using are?
Purchase returns and allowances.
And
Cash.
or a credit?
AR.
So I gave you inventory. No, I purchased inventory, right? I purchased $1,000 of inventory, but now I only want 500 of it. So I'm giving you back $500 of it. Originally, when I got that $1,000 of merchandise, I credited my AP because I haven't paid it yet. So now what you're going to do, or what I'm going to do, is I'm going to lower my accounts payable by 500 because now I only need to pay you back $500 of it because I gave you back $500 of the inventory that I didn't want. Does that make sense? Okay. So the adjusting journal, or the journal entry should be a debit to AP and a credit to purchase returns and allowances. So this lowers my liability and this increases my net income because purchases are an expense account. And if you're returning some of it, then you have to unexpense it like we did in the first one, right? Or the one before. So in terms of accounts, so nothing happens to our assets because neither of these accounts affect assets. In terms of liability, it should have been lowered and it wasn't, so it's overstated. In terms of purchases, just like we did in the first one, we have to unexpense, we have to give some of our expenses back, right? So if we're taking away some of our expenses, then our net income is understated. Everyone good on this one?
Can you explain the net income part of it, how it's understated?
So in my expenses right now, I have $1,000 worth of expenses and my net income is $10,000. So my revenue is $10,000 right now and I've purchased $1,000 worth of inventory, which is an expense. So my net income is $9,000 right now. But now I gave $500 worth of the purchases back. So now my expense for my purchases is only $500, which makes my net income now $9,500 instead of $9,000. That's why it's understated. Just like I did, it's the same exact thing that we did in the first problem. Not first problem, the one before this. Good? Okay. Number 11. Okay, someone needs to do this one. Someone that hasn't talked yet. Maybe. You guys can do it in the chat if you don't want to talk.
Yeah, guys, let's try to make this as more interactive as possible so we all don't just like die of boredom.
It's not going to help you if you're just letting us do all of it for you.
Yeah, we're not going to be there for your exam. Think about that.
May I try?
Mm-hmm.
Yeah, of course.
So alphabet destination, the seller pays, right?
Mm-hmm.
Ariana, I think your screen froze.
I'm not doing anything.
Oh, never mind.
I was just waiting for him.
They shouldn't even record the sell in their inventory, right?
Are they the purchaser or the seller?
Alpha, the purchaser. They should have waited, right, until they get the inventory.
So as of December 31st, the merchandise had not been received. They recorded the purchase and included that in their ending inventory.
So they should take it out from their inventory.
It shouldn't be in their inventory, and shouldn't they have recorded the purchase?
Yeah. Is it correct?
No. Why are they recording the purchase if they haven't gotten it yet? It's FOB destination.
They shouldn't have recorded anything yet.
They shouldn't have recorded anything. What was the journal entry they did for recording the purchase?
So they increase their assets.
Is it the periodic system or the perpetual system?
Periodic.
So what's the journal entry?
purchases.
Mm-hmm. And credit to.
So it's on credit accounts payable.
Yeah. Credit. And what about when they debited their inventory at the end?
I don't know.
Jesus, is this the one that I should just like increase my inventory, not do it?
Yeah.
You want to explain that?
It's OON. So I think just purchases and AP are correct, but in the answers, it's assets are overstated.
Mm-hmm.
Yeah, because they increased it instead of doing
They
nothing.
increase their inventory.
Yeah, I think this transaction alone is fine. I don't think we should consider inventory because it is under the periodic system. But like he said,
But assets are overstated.
Also,
yeah,
So
they increased their liability instead of doing nothing, so they overstated their liability.
yeah. Hold on. So in terms of inventory, which is an asset, since we're using the periodic system, we're not doing a journal entry for debiting inventory and crediting cost of goods sold. But so there's no specific journal entry, but in terms of T charts, we should just be increasing our inventory, if that makes sense. So when I do the T charts, I'm going to do inventory, AP, and purchases. So now they included it in their ending inventory, which they shouldn't have. They increased their liability and they did their purchases. So now let's talk about what the answer is. Oh wait, hold on. So this decreases your net income. Liabilities are increased. So what is the answer?
They overstated their assets and liabilities.
They what?
They overstated their assets and liabilities.
Okay, what about their net income?
Nothing.
Why?
In the back it says OON.
Yeah, Jesus, I think it is a debit to inventory and a credit to COGS. Because the debit to purchases and the credit to COGS would balance each other out. That's why there's no effect.
Yeah, but it's periodic.
But it's the end of the period that they're including the inventory, and you do that, the inventory and COGS at the end of the period. Okay. So, sorry guys. So in periodic, you don't do COGS until the end, right? But now they're looking at their ending inventory and now it's the end of the period, so now they can do COGS, right? So what they did was they debited inventory and they credited COGS. And this increases your assets and this increases your net income because COGS is an expense. And if you credit it, then it's going to increase your net income. So net income is no effect because the purchases lower it and the COGS increase it by the same amount. Does that make sense? Everyone good on that?
Can you do the T account for?
Yeah, sorry. Is that good?
Yeah.
Okay. Number is that 12. So number 12 says off of
12, Ariana.
huh?
You can do 12 if you want.
Good.
So it says Alpha should have recorded the purchase of supplies on credit, but didn't. As a result, no AGE was recorded at year end for the amount of those supplies used. So it looks like they failed to do pretty much the transaction and the AGE that follows. So what will my transaction look like if they purchase supplies on credit?
Supplies and AP.
Very good. So debit supplies and credit accounts payable. Does your screen froze?
Yeah, hold on.
Oh shit, okay.
What's the journal entry?
It's debit supplies and credit AP. So they also forgot to record the AGE for the amount of those supplies used. So can someone other than Jane tell me what my transactions will look like?
So we debit expense and then credit supplies.
Yes, so it's debit supplies expense and credit supplies.
Full amount.
What happened?
But they only. Oh, no, I'm just kidding. Well, are they using the full amount of supplies or are they only using?
It says for the amount of those supplies used. So they're not using the entire amount. So I will put like $1,000 for supplies and AP, and maybe like 500 for supplies expense and supplies. Supplies expense is affecting net income by bringing it down, and then supplies is affecting assets by bringing it down. So let's start with the assets first. So we saw that we bought some supplies under credit, but we used up $500 of those supplies. So there's still $500 of supplies left that we forgot to record. What does that do to my assets?
So we understated our assets.
Okay, good.
Understated?
Yes, because we forgot to record the journal entry for supplies.
Okay.
And then we just have one liability account, which is AP, which is, we forgot to record the payable, which is also going to be what? Understated our liabilities, right? Yes?
Yeah.
Okay. Then for net income, we forgot to record the AGE for supplies expense, and it brings our net income down. So what does that do to our net income?
So
we omitted it.
Overstated.
Overstated. Okay. Any questions?
I have a quick question.
What's up?
In this scenario, it was that we didn't use the entire amount of supplies. We had like 500 left over.
Say like we used the complete amount for supplies, then I don't think there will be an effect for assets because those supplies will be gone. However, we still need to take into consideration the accounts payable and the expenses. Right? Ariana?
What?
Right?
I'm sorry. I was messaging something.
She was asking if, say, like the supplies are fully expensed, then assets will be no effect because we won't have the supplies anymore.
Yes.
However, we still have to consider the accounts payable and the supplies expense.
Yes. Correct.
So in other words, only assets will change.
Assets wouldn't change if they credited all of it.
Yeah.
Okay. 13.
All right. Alpha failed to record the prepayment of 1 year of rent paid. Alpha also failed to record an AGE at the end of the year when there was still 9 months of the time remaining on the lease. So similar to 12, they forgot to do the transaction and the AGE. So can someone give me my debit and credit for the first scenario?
Can someone message this in the chat that hasn't said anything yet,
Yeah.
please? What's the original journal entry for recording prepaid rent?
Is it rent expense and prepaid rent?
No. They paid cash. Yeah, debit, prepaid rent, and credit cash. Because they're increasing their assets and lowering their assets, they paid cash for it, and now they have an asset of prepaid rent that they already paid for. Does that make sense?
Yeah, thank you.
Mm-hmm.
Oh my God. So now what's the adjusting journal entry for, okay, so I'm gonna do that 12,000 again because we're not expensing all of it, right? Yeah, so there's 9 months left on the lease now, right? So that means they've only used how many months?
3.
They've only used 3 months. So what is my journal entry for expensing those 3 months and for what amount?
With debit rent expense. Not prepaid rent.
And credit what?
Prepaid rent.
For how much?
3,000.
So cash rent are both assets, right? And my rent expense goes over here. So my cash should have been debited for 12,000. My prepaid rent should have been debited for 12,000 and credited for 3,000, which means my balance in my prepaid rent account is 9,000, which is correct because we have 9 months left on the lease, right? And then it should have been debited for 3,000. So can someone tell me what the answer is for assets?
You.
Why is it understated?
Because
So it's overstated because the $9,000 was never recorded for the prepaid.
No,
The balance in the prepaid.
Oh wait, hold on. I'm sorry, it's so wrong. No. Hold on. It's overstated, right? There's 2 accounts that you have to be looking at. You said U and U. So cash and prepaid rent are both assets. So my cash, let's look at cash first. My cash was my cash should have been credited by 12,000, which would have lowered it by 12. And then my prepaid rent was increased by 12, but then lowered by 3. So if it should have been, so that's okay, so it's like a cash or prepaid rent rate. So it should have been increased by 12 and then lowered by 3. So net should have been increased by 9 but then cash should have been decreased by 12. So net between both of them should have been decreased by 3. Which
No.
my
Are
assets.
you sure?
What?
I'm confused there because prepaid rent and the cash is $12,000. Basically, is which you already is a cash account for the both side.
Yeah. So the prepaid rent and the cash, debit and credit, they balance each other out, right? You increase
exactly.
one, decrease one, but now prepaid rent also has to be decreased by 3,000 because you used 3 months of it, and so it's your assets should have been decreased by 3,000, which means your assets were overstated
by 9,000.
No, by 3,000.
So you bought an asset in exchange for an asset.
Yeah.
Bought prepaid rent for cash. Since they're both assets, they cancel each other out because you're just transferring over to one account from another. However, since this is an accrued expense, our prepaid, it's sort of like depreciating. So like we'll be using up the rent throughout the year. Since we failed to record the AGE, our prepaid rent never went down. So there's too much assets that we have in our books. So that's why it's overstated by 3,000.
Oh, I get it. I knew it was overstated, but because I was looking on your figures. Yeah, I get it now.
Okay.
It's 3,000 and not the 9.
Cool. So in terms of liability, nothing, right? Because none of these accounts have
I got it. Get it.
And then for expenses, they should have been expensed by 3. So our net income is overstated because we should have expensed $3,000 worth of rent. So it's O-N-O. Everyone good on that one?
Uh-huh.
Going to 14. So with 14, Alpha sold merchandise to Beta on credit with terms FOB shipping point. As of December 31st, the merchandise had not yet been received by Beta. Alpha did not record the sale and counted the merchandise in ending inventory. Let me ask you guys something. Was Alpha allowed to dismiss the recording of the transaction or not? So my question to you guys is, should Alpha record the transaction or not?
Yeah, they should have because they're the ones selling it. So they should have done that.
Okay. So what will my transaction look like? My journal entries.
So
should have recorded the sale, right?
Is it credit inventory and debit AR?
So it's under the periodic system and they sold merchandise on credit. So it will be a debit to accounts receivable and a credit to sales revenue.
Sales revenue. Oh.
However, since they also counted it in their ending inventory for inventory, we also have to record it as a debit to inventory and a credit to COGS. I'm sorry, a debit to COGS and a credit to inventory. Those are assets, net income. Net income is going down, and then inventory for assets. Let's put in numbers for this. So say our selling price was like $1,000 for AR and sales revenue, and our COGS margin was, let's say, like 25%.
Your COGS margin or your gross profit margin?
My gross profit margin, I'm sorry.
So 750 to make it?
Yeah.
Okay. Oh man. Okay. AR inventory. Oh, that's not a straight line. So,
You are correct. Inventory is only under perpetual. However, since this is at the end of the year, we have to include COGS in inventory.
so the answer, if AR should have been increased, so like for assets, AR should have been increased by 1,000, but we took 750 out of our inventory, then net should be increased assets by 250. So our assets are understated. And then there's no liability in this case, so nothing for liability. And then in terms of net income, should have been increased by 1,000 with the sales revenue, but decreased by 750 with the COGS. So net should have been increased by 250, which means our asset or our net income was understated.
Any questions?
Not for me.
Okay, thank you. Let's move on to 15. So number 15, offer paid cash to satisfy an account payable, but I can't even pronounce the word, but did not record it as a dividend paid to shareholders. The declaration of dividend was previously recorded. So with the livelihood of a dividend, you declare it by debiting dividends and crediting dividends payable. And then when it gets paid, it's dividends payable as debit and then cash as credit. So in this case, they paid the dividend, but they should have paid their accounts payable. So what they did wrong was credit dividends payable and I'm sorry, debit dividends payable and credit cash. Where they should have done is debited accounts payable and credit cash. Does anyone see any relationship between these two journal entries?
They're the same thing.
They're the same thing, right?
So what's the answer?
Nothing.
Nothing.
Good job, guys. Guys, is the way that I'm doing the journal entries and the T-charts okay? Is it helping you understand?
Yeah.
Okay. I just want to make
And
sure.
can you make a box of, for example, if sales revenue T account normal balance is credit, can you make a box on the credit side? So like we know, I don't know.
Wait, can you say that again?
For example, like when you make T account and the revenue account normal balance is credit, can you make a box on the right side?
Like, okay, so like I have a sales revenue here. Like, what do you want me to do with this?
Like make a box around 1,000, so we know the normal balance of the revenue account is.
Like that?
Yeah.
Oh, so like if I shouldn't be, because like for this one, inventory has a normal debit balance. Like, don't make a box around it.
Like you can make a box on the left side.
Okay, I see. Okay, that's fine. So like this, we have cash, AP, and DP. So like that? No, wrong.
Yeah, thanks.
Mm-hmm.
And one more thing. So tomorrow we're gonna do the same thing.
Yeah, it's the same Zoom ID as today's.
With you, right? With both of you.
Wait, what happened?
With both of you, same people.
Yeah, same people.
Okay.
Well, if he likes us or doesn't like us.
Yeah.
I do.
He's like, maybe I should pick another ID tomorrow.
All right, 16. Alpha made a cash sale, but did not record it as a loan from a bank. All right, can someone tell me my journal entries?
You just say like accidentally or something.
Okay. Because I can't say that word.
Yeah, I can't say it either. It's okay. It's a stupid word. Just say accidentally. So what they do wrong is, everyone participate in the chat if you don't want to talk. Please, it's like, trust me, it's really going to help you.
Yeah.
I lost it. Yes, that's right. They debited cash and they credited loans payable. And what should they have done? Yes.
Yay, cash and sales revenue. So they recognized cash correctly by increasing it. However, they did not recognize it on the credit side. So instead of recognizing it as revenue, they recognized it as a loan payable. So since cash is fine, assets are no effect. What about my liabilities? If we incurred a payable by accident, what does that do to our liabilities?
We overstate our liability.
They're overstated, right? Because it shouldn't be there. And then since we forgot to recognize it as revenue, what does that do to our net income? Understated.
Oh, sorry. That's wrong.
I had a question. For sales revenue, it's the same thing as revenue, right? We don't have to put sales. It just
yeah.
Yeah, like when I came into 350, because I transferred, we just used revenue, and then I saw like there were like service revenue, sales revenue. It's the same thing.
Okay, thank you.
You're welcome.
And the journal entries are really just to help like your thought process, because the only answer you're doing is like the NOU, right? So it's really whatever you want, as long as you know that it's revenue and it has a normal credit balance. That's all you need to know. That makes sense.
Yeah. All right, 17. So Alpha accidentally recorded an AGE for interest on a note receivable instead of the correct AGE of interest. I'm sorry, an AGE for interest on a note payable. The interest will be paid into Alpha until next year.
So what's the wrong entry?
So they credited interest payable by mistake.
No, they wrongly recorded an AGE for an interest on a note receivable.
Oh.
So if they have a note so if I have a note receivable and I'm earning interest on it, I'm getting money. So what's my journal entry?
So they debited interest receivable and credited interest expense?
No, you don't credit interest expense unless you're unexpensing. So if if I gave Jesus $1,000 and he has to pay me back with interest, that's revenue for me because I gave him money, but now I'm also earning money on the interest that he owes me. So I debit interest receivable and I credit interest revenue because I'm earning money now. I'm getting more than my $1,000 that I loaned to him. But now they should have recorded it as interest on a note payable. So what's the journal entry for that?
Debit interest expense, credit interest payable.
Yes, good. So this is an asset that increases. This is net income that increases. This is net income that lowers it. And this increases your liabilities. So what's the answer, guys? What?
They overstated their assets.
Okay.
And then they understated their liabilities.
Good.
No, never.
Yeah.
Yeah. And the last part, I don't know.
So if they increased their revenue when they shouldn't have, net income is okay. If they increased it when they shouldn't have and should have decreased it, like this right now. So what's this? More than this. So it's overstated. Does that make sense?
Yeah.
Okay. Everyone good on this one?
So with 18, offer purchase equipment on credit but did not record it. No payments were made during the year and no AGE was recorded for the depreciation on the equipment. So if they bought equipment on credit, there will be debit equipment and credit AP. They also failed to record the AGE for the depreciation, so it will be depreciation expense as debit. And as a credit, it will be accumulated depreciation.
Jesus, can you just explain what the part means about the no payments were made during the year?
Yeah, so say they bought the equipment at the beginning of January, and for the rest of the year, that liability just stayed and no payments were made. So throughout the year, there weren't any adjustments to that liability. It just stayed in the books, basically. In other words, like throughout the year in the books, there will be no transactions such as like debit, AP, and credit cash, since no payments were made.
Oh, we should use numbers.
Yeah. Let's say it's 10,000 for the equipment. Well, 12,000 since it's 12 months in a year.
And how much for the
1,000. So let's look at the assets first. They failed to record pretty much everything. So what happens to my assets?
They understated their assets.
They're understated because they did not recognize the equipment.
How much did they understate it by?
11,000.
Good.
And my liabilities?
Understated.
Yes. They did not incur the liability, so it's understated. And what about my net income?
Understated? No.
Understated.
Overstated.
Oh, it's overstated, sorry.
Why?
Because expenses decrease your net income. So if you didn't record an expense, your net income is too high right now. Someone want to try 19?
I'm gonna call on someone.
Yeah.
Let's have Lania do 19.
Sure. So you debit interest receivable and you credit interest revenue.
What kind of account is interest receivable?
An asset.
And by debiting it, do you increase it or decrease it?
You increase it, so it was understated.
Okay. What about interest revenue? What kind of account does that affect?
That affects net income.
Does crediting it increase it or decrease it?
Increase it. So again, it was understated, and liabilities are just not affected.
Good.
Good job.
You want to pick someone else?
For 20, let's do Olivia. And like, it's okay if you need help. Like, well, that's what we're here for.
So I would do cash debit, and then
What's the mistake they made? Tell me what the journal entry is for the mistake that they made first.
oh, they wrote it as a cash sales, cash sales credit, right?
So debit cash and credit what?
Sales.
Yep. And what should they have done? What was the actual, what happened?
The actual one would it be cash debit? And then I'm not sure what goes on the credit.
So they receive cash from a bank and report it as a cash sale instead of a loan that they have to repay. So now what do we do about the loan? How do we record that?
Would it be loan payable?
Mm-hmm. So what type of account is cash?
It's an asset, my bad.
And does debiting it increase it or decrease it?
Increase it.
And what kind of account is sales?
It's a net income.
So does crediting it increase it or decrease net income?
It would increase it.
Yep. And then we already got cash. And what about loans payable?
That would be a liability.
And does crediting it increase it or decrease it?
It will increase it.
Okay. So did they do the cash part right?
Yes.
So what's my answer for assets?
It would be no effect.
And then what about liabilities?
Liabilities. Hold on 1 second.
So they have a liability that they didn't record. So they
Right.
credited loans payable, but they didn't. And loans payable crediting it increases your liabilities. So
it would be understated.
Understated. It's understated because they didn't record it, right?
Right.
And then what about net income?
It would be overstated.
Why?
Because
Because they recorded sales when they shouldn't have.
right.
All right, good job.
So for 21, let me see. Let's have Jesse G do 21.
You can do it in the chat if you're not comfortable talking.
Yeah. Oh.
If you don't want to do it, just let us know in the chat and we can pick someone else. But say something, please. Okay, maybe pick someone else.
Let's have Rosmeek do 21.
So they did a mistake by debiting cash and crediting accounts payable. Right.
Crediting. Wait, say that again.
They debited cash and credited accounts payable.
They paid cash to satisfy an account payable.
Okay. Then they debited accounts payable and credited cash.
Yeah. And what should they have done? They paid cash for 1 year of rent.
So prepaid rent debit. Credit cash.
And then they also forgot to do something else.
And then they should debit rent expense and credit prepaid rent.
And when did they purchase the prepaid rent?
Say it again.
When did they purchase the prepaid rent?
On the 3rd month.
So did they use the 1 year? Like if it's the end of the year, should they be expensing all of it or should they only be expensing part of it?
Part of it.
So if my prepaid rent was $12,000, $1,000 a month, how much should my prepaid expense be at the end of the year?
Is it
the beginning of the 3rd month? So they used, so like they bought it March 1st.
like 10,000?
Yeah, good. Good. So AP is what kind of account?
Liability.
Does debiting it increase it or decrease it?
Decrease.
Cash?
Asset decrease. Prepaid rent asset decrease. I mean increase. No, cash is assets, so decrease. Rent expense.
Increase or decrease net income?
I mean, decrease.
And prepaid rent?
It's an asset, we have to decrease it.
Okay. So in terms of our assets here, wait, let me write. Do you want me to do the T charts before I ask you the answer?
Can we do the T count?
Yeah. So cash, prepaid rent, we have AP, and our rent expense. What should I be putting in cash?
On the credit side, their mistake 12,000, and then the correct 12,000. So that's fine. And for prepaid rent on the left side, 12,000, and then on the right side, 10,000. So it means they understated their prepaid rent.
They understated their assets. Yeah, good. And then AP is debited by 12, right?
Mm-hmm. So they overstated their liabilities.
No.
Hold on.
So if they lowered their liabilities when they shouldn't have,
they understated.
Rent expense is 10,000, right?
And they understated their net income?
If you didn't record an expense, your, hi Jenny, if you didn't record your expense, then your net income is overstated because you didn't lower your net income with that expense. So it's overstated. Does everyone get this one? Can we explain the assets? Yes. So they did the cash correctly, right? They credited cash, they credited cash here, and that's fine because they should have done it here, right? So those balance each other out. That's fine. But they never recorded the prepaid rent, which increases your assets, and they never credited their prepaid rent because they use 10 months out of the prepaid rent, right? So we still have $2,000 of prepaid rent that wasn't recorded, which increases your assets. So your assets are understated. Did that make sense? Okay. Number 22. Someone want to do this one? Yes. Susie.
So they incorrectly recorded it as a debit to supplies and a credit to cash.
Okay.
But it should have been supplies debit and accounts payable credit, right? And then supplies, it's an asset, and then it was increasing when it's a debit. And then cash as a credit, it's an asset, but it's decreasing in credit. And then supplies, it's also an asset. When it's debited, it's increasing. And then accounts payable is a liability, and when it's credited, it's increasing.
Cool.
So I did it on my own. I just wanted to make sure it was correct. I got assets understated, liabilities also understated, and then net income not affected.
Can you explain each one and then I'll... So why are assets understated?
Because first it was increased and then decreased and then increased again. But so it made sense in my head. I just don't know how to explain it.
Well, I wouldn't think of it that way because you said it was increased and decreased and increased, right? But it was increased correctly the same way. So think of that as one increase.
Okay.
So the increase was correct, but the decrease was wrong, right?
Right.
So it's
okay. So because it was decreased, that's why it's understated.
Yeah, like look at it like this way. Like, so they got supplies, they just got it the wrong way. They use their cash instead of like their liabilities. So in reality, your cash is understated because they should have never bought supplies with cash.
Okay.
And then the liabilities, can you explain to me?
Well, because they never recorded the liability, so and it's increasing, so that's why it's understated.
And the net income?
There's no net income, so there's no account that was affecting net income, so it's no effect.
Good.
Wait, can you explain why assets is understated again?
Yeah, so they acquired some supplies, however, they recorded it incorrectly by how they got those supplies. So in the incorrect journal entry, they used their cash to buy supplies where they should have used their liabilities to acquire those supplies. So since both supplies are assets, that's correct because they both got supplies, but they just bought it like incorrectly. They used their cash instead of like their credit card or something.
Okay, thank you.
I agree. Alpha made a cash sale but recorded it as cash received from a customer as a payment to satisfy an account receivable. Should I call someone out? Someone want to do this one?
Jesse, did you fix your mic?
Yeah, I did.
Okay. You get it fun.
All right. I guess what they did was they debited accounts receivable, I guess, and credited cash.
No. They recorded it as cash received to satisfy an account receivable.
Oh, okay. So it would be
What did they do wrong?
they should have debited cash and credited sales.
No, what did they do wrong first? That's correct, but what did they do wrong?
They accidentally used the cash flow to satisfy an accounts receivable.
What's the journal entry for that?
It would be accounts receivable debit.
No. That debiting your accounts receivable increases your accounts receivable, right?
Oh, okay.
Someone gave me cash to lower my account receivable because they now pay me.
Would it be accounts payable?
No. You debit cash because they give you cash and now you're lowering your AR.
Oh, okay.
And now what's the correct one that you said?
Debit cash and credit sales.
So what type of account is cash?
Asset.
Does debiting it increase it or decrease it?
Increase.
What about AR?
Asset and it decreases.
What about sales revenue?
Income.
Increases what?
the net income.
Let me just do T-charts really quick. So they did this, right? They should have done this. So in terms of assets, what's the answer?
It would be, I would say, understated.
Understated? Why?
Because they've never recorded the cash sale.
Well, they recorded the cash coming in by debiting cash, but they credited AR. And they lowered their asset when they shouldn't have. That's why it's understated.
Yeah.
What about liabilities?
Matter of fact, there's no account on there that would.
What about sales revenue?
It would be understated.
Because?
The sales revenue was never taken into account.
Yeah, good. Okay. Number 24. Someone want to do this one? No? Okay, I'll do. Alpha failed to record the return of inventory to the vendor for cash. Assume the use of periodic inventory system. So they did not record the return of inventory. And when we use the periodic system, can someone tell me what the account is when I return something? So when I got the inventory, yeah, it's purchases, but now I'm returning some of it. So what's the account? That I would use for the return of my purchase.
The accounts payable, debit, and then purchase returns credit.
Why accounts payable?
Oh, wait, is it? Because we're returning, right?
They got cash.
Yeah.
So I'm gonna debit cash and yes, good. Purchase returns and allowances. So cash is an asset and that increases when you debit it, and purchase returns are a contra purchase account, and a purchase account is an expense. So if it's a contra account to that, it increases our net income. So we have cash and then purchase on A. So that. So if our cash was never increased, our assets are understated and there's no liabilities in this case. And if our purchase returns and allowances were never recorded and purchase returns and allowances increase our net income, then our net income was understated. Everyone good on that one? Okay. 25. So they failed to record the following adjusting journal entry. The sales account includes a $5,000 payment received in advance from a customer. So I already know that in advance means it's unearned revenue, so it really shouldn't be in the sales account, but it's fine. by year end, only 3,000 of the merchandise had been delivered to the customer. So if I've only earned 3,000 of it, but there's 5,000 in my sales account, then I have to take how much out of it? Good. So what's my debit and what's my credit? $2,000 of it I haven't earned that $2,000 yet. And so I have to take it out of my revenue. And if revenue has a normal credit balance, then I have to debit it to take it out. And so I have to debit revenue, but what do I have to credit? Yeah, unearned revenue. Because now that $2,000 is a liability on my part. I still have to fulfill that for $2,000. So unearned revenue is a liability, and revenue is that. So this is this is net income, and this decreases it when you credit it or debit it, and this is a liability that increases. So assets are affected in this case. Our liability was not increased, which means it's understated, and revenue, there's too much revenue, which means our net income had to be lowered, so our net income is overstated. Does that make sense? Does anyone want to try the next one? Maybe. Stanji, are you still there? You want to try this?
25.
Yeah, go back to 25. Yeah. Do you have a question or do you just want to see it? Okay. Okay. So can someone do 26, please?
Screen is acting up. Let me see if I can try that. Can you hear me?
Yeah, I can hear you.
Okay, 26. So because rent was paid in advance, it would have been prepaid rent and cash. But because they failed to record AJE, the rent had been used except for 1 month. So it would be rent expense, debit, and prepaid rent credit.
Am I crediting the prepaid rent for the full amount that I was debiting it for?
Read?
Huh? I'm sorry?
Could you repeat what you just said? I didn't hear what you just said. Hello?
I said when I purchased the prepaid rent and I debited it, am I expensing all of it? Did I use all of it?
No, you didn't use all of it. You only used 11 months, so 1 month is remaining.
So I'm gonna do 12,000.
12,000, 12,000.
And what number should I put here?
1,000.
1,000?
Because you expense 11 months already, so only 1 month is used.
No. This is my journal entry for expensing it. I haven't expensed any of it yet.
For the first part, this is prepaid rent and cash is 12,000. So we're going to expense it out now.
You have to expense it by 11.
11?
Mm-hmm.
Okay, yeah, you're correct. So expenses for 11 and prepaid is 11.
Because now, okay, so like this is like why it's 1 month, right? They purchased it on February 1st and they used 11 months. Now it's December 31st and now they have to expense 11 months of it. So now in my prepaid rent account, I had a debit balance of 12 and I have a credit balance of 11, which means I have 1 month left to use.
Right.
Yeah. So cash, prepaid rent, and then rent expense. So 12,000. All right, so what's my answer?
So assets
Mhm.
would be overstated. Nothing for liabilities. And net income would be overstated.
Good. Very good. Any questions on this one?
Can you explain assets again?
So yeah, so if our cash, so nothing was done in this case, right? So here in my two accounts, I have my cash account and my prepaid rent account. And my prepaid rent should have been increased net by 1,000, but decreased by 12. So it should have been decreased by net 11. So that's why it was overstated. Does that make sense?
Thanks. Mhm.
Okay, I'm gonna move on. Okay, 26. Alpha failed to, no, sorry. Oh, this is 27, huh?
Yeah.
You want to do this one again, Jesus?
Sure.
Can I just like copy it?
What happened?
This was in the first one too.
Oh, yeah.
Just gonna copy
Copy
it.
that little, yeah.
Yeah.
What happened?
It's just, being trivial.
All right, so for 27, they just failed to record the AGE. So they say salaries are paid every Friday for a 5-day work week. The normal payroll is $40,000. The year end falls on Tuesday this year. So how I like to approach this problem is just by drawing out the weeks, since it's a 5-day work week, and cutting off the year end. So it looks like Tuesday is 12/31, and they have to adjust for that for those 2 days. So it would just be 16,000. Or you can just take the payroll amount, which is $40,000, and then just multiply it by 2 divided by 5. Is everyone following so far?
Yes.
Okay.
Moving on.
Oh wait, yeah, it's like the same one, right? 16,000. So salaries expense and salaries payable will be your adjusting journal entry. So salaries expense decreases your net income, and then salaries payable increases your liability. Since they completely forgot to omit this, your liabilities will be understated, and then your net income will be overstated.
Everyone good?
Any questions how I got 16,000? Nope. Okay.
Okay, 28. Failed to record an adjusting journal entry. Examining the rent expense account, the controller finds it includes a $4,800 advance payment for 3 months' rent. The payment was made on November 1st. So they just failed to record the adjusting journal entry. So I like to think about what the original one is. So if there's a balance in the rent expense account for $4,800, that means that they debited rent expense for the $4,800 and credited cash. But now it's the end of the year and they've only used 2 months when they've already expensed 3 months. So now we have to unexpense and increase our prepaid rent because for the month of January for the following year, we have to have that asset of prepaid rent. So we have to debit prepaid rent for $1,600, which really doesn't matter. But this is 4,800 times 1/3, if anyone cares about the number. And then rent expense. Rent expense for 1,600. So prepaid rent is an asset. And rent expense affects net income. And we credited it, but it has a normal debit balance, and we debited this. So prepaid rent increases our assets, and this increases our net income because we're crediting it. So in terms of assets, our assets were understated because we didn't debit that prepaid rent. Then in terms of liability, nothing is affected because neither of these accounts affect liabilities. And then in terms of net income, if we're taking out some of our expenses, then our net income is going to go up, which means our net income was understated. Everyone good on that one?
Yeah, I think that was a repeat.
Can you explain why rent expense increased our net income?
Because we're crediting it.
Credit. Oh.
Do you want to try this next one? Number 29.
So we have to increase our supplies.
We're just recording the adjusting journal entry.
Oh, no, I forgot this one.
Do you need help?
Yeah, can you start? I don't know.
So we're just failing to record the adjusting journal entry. So when they got the $3,500 worth of supplies, we don't have to worry about that. They debited supplies and credited cash, whatever. but now they only have $500 of office supplies left. So obviously they used up how much of it?
3,000.
Yeah. Because at the beginning of the year, there was nothing, right? So they used up 3,000. So what's our adjusting journal entry for supplies when we use some of it up?
We debit our expense
Mm-hmm.
for 3,000. And then we credit supplies.
Yep. So this is net income, and it decreases it because it's an expense, and supplies go down. So our assets go down.
Someone asked a question, if all supplies were used at year end, would the journal entry be a debit to supplies and a credit to supplies expense?
No, because a debit to supplies increases your supplies, right? So if you're using all of them up, then you have to expense them. So it's the opposite. It's the same exact journal entries I'm doing right now. It would just be for the total 3,500. Does that make sense? Yeah. When you purchase the supplies is when you debit it, and then you credit the cash or your AP that you have to pay for it later. So what's my answer?
So we overstated our supplies. Nothing for liabilities. And we overstated our net income.
Yep. Good job. Yes, it is. Oh, I know. I don't know who this person is because your initials, it's just your initials, but do you want to do the next one?
Is it the BL?
Yeah.
Okay.
Jesus, maybe tomorrow I'll match headbands with you.
What happened?
I said maybe tomorrow I'll wear a headband and match with you.
Oh, thank you. I just woke up like 3 hours ago.
So correct. Oh, so the correct one. Sorry, I didn't even read journal entry. You received an order made 13,000 advance payment, which is credited to unearned revenue. For the correct one, they have to debit unearned revenue and credit sales. Yes, that is correct. So they have to lower their liability because now they've earned all the revenue and debit their revenue. So in terms of T accounts, so what did you get the answer to be? Look at the answer. Do you have the answer? And you, oh. So nothing happens to assets because they're not affected. Unearned revenue was, you said understated? No. Unearned revenue is going to, well, our liabilities are going to be overstated because we had to lower it because we didn't lower it. So they were overstated. And then our revenue wasn't recorded. So our net income is understated. Does that make sense? Okay. Number 31. Does anyone want to do this one? Okay. This is the same one that we did in the handout 4. So they failed to record an adjusting journal entry. They have a $20,000 9-month 12% note payable outstanding at the end of the year. The note was issued on October 1st and the interest is to be paid. So we already took care of the liability for the note payable, but now we just have to do the adjusting journal entry for the interest. So the way I find, I mean, the amount doesn't really matter, but the way you find the amount is the amount of the note times how many months you've accrued interest for, which is 3 out of 12 months, times the interest rate. And I'm not using 9 months because the interest rate is always based off of the year. The 9-month just means that they have to pay it back in 9 months. It has nothing to do with how I calculate my interest. And so this is $600. And so in order to recognize the expense, I have to debit the interest expense and credit payable because I'm not paying it until I pay the note. So interest expense affects net income and it lowers it, and payable is a liability. So interest payable. So nothing happens to my assets.
We understated our liability.
Good. And
we overstated our net income.
Good. Jesus, you want to do the next one?
32? Sure. So it says they failed to record the AGE. Examining the unearned revenue account, Alpha's controller finds that it includes $6,000 for 12 months of rent received from one of the tenants on October 1st. So can someone tell me, let me ask you guys a different type of question. What type of AGE is this? Is this an accrued revenue, a deferred revenue, an accrued expense, or a deferred expense? Because I guarantee you that's going to be at least 3 questions on your final.
Deferred.
Deferred what?
Revenue.
Good. So what will my journal entries be?
We have to debit unearned revenue and then credit revenue.
Yeah, because they're earning some of that unearned revenue.
Do you know how much?
What happened?
I asked him if he knew how much we would be doing.
1,500.
Yeah.
Unearned revenue is a liability, so when we debit it, we're gonna decrease.
Oh, sorry. Liability and revenue.
increase our net income.
What's the answer?
So nothing for assets. We overstated our liabilities and understated our net income.
Mm-hmm. Good job.
All right, so 33. It says Alpha recorded a cash purchase of inventory using the periodic inventory system, but accidentally recorded it as a debit to supplies and a credit to accounts payable. The inventory was counted in ending inventory. Let's have Olivia do this one. So let's start off with what they did incorrectly.
Okay, so did supplies, debit, and accounts payable credit.
All right, good. And then what was my correct inventory? My correct transaction journal entries.
Purchases, wait, no. Yeah, purchases, debit, and then cash credit.
Okay. So it looks like it is under the periodic system. So at the end of the year, they counted it in the ending inventory. So we also have to consider the inventory, right?
Oh, yeah.
So what does that do to my assets?
Sorry, can you repeat that?
Yeah, so how will my assets be affected? Will they be understated or overstated if they fail to record the purchase of this inventory?
I think it would be understated.
Understated? How come?
Because they forgot to record supplies. Or wait, no, that's what they did. Supplies is an asset, right? I mean,
So since they incorrectly recorded supplies instead of the purchases, our assets will be overstated.
okay.
Can we do the T account?
What happened?
Can we do the T account?
Sorry. We're just waiting. So we have. Am I doing inventory too?
Yeah, let's do inventory.
So. Do we have the answer already?
What's the entry for inventory? What's the journal entry? Is that inventory and cost of goods sold, or what is it?
Did we do it on this one, Jesus, or did we just include inventory?
You just indicated inventory as increasing, so just like how you have it.
So the answer, if our assets went up when they should have gone. What's the answer, Jesus?
It's OOO.
Oh. So our supplies went up when they shouldn't have, but then inventory went up, so that cancels each other out. And then cash should have been decreased. That's why assets are overstated. And then in terms of liability, wait, hold on. Yeah, in terms of liability, it was increased when it shouldn't have been. That's why it's overstated. And then purchases should have been they should have been included, which is an expense to net income. So that's why net income is overstated. So inventory costs are not taken into account when determining. They are. It's just not COGS that we're taking care of right now. Just think of it as inventory just being included, not COGS.
Why is net income overstated again?
Because purchases are an expense, and if we didn't do this yet, right? We didn't like we should have done this, but we didn't, and so it's overstated because we haven't included the purchases yet.
Okay, thank you.
Okay, number 34. Alpha made a cash sale to a customer, but recorded it as a payment to satisfy an account receivable. So what they did wrong was they got cash, which is fine, but they recorded it as if they were satisfying an AR account. But what they really did, or what really happened, was they debited cash and credited sales. And this is an asset that increases, but this is an asset that decreases. But net income should have been included on this one. So cash was done correctly, which is fine. AR should not have been included. So cash cancels out, that's fine. AR should not have been recorded, so that's lowering our assets when it shouldn't have been. So our assets are understated. In terms of liability, nothing happens. And then in terms of sales, it wasn't recorded, so our net income is going to be understated. Everyone good on that one?
$35.
Almost done.
So it looks like they just failed to record a cash sale.
Okay, let's see if someone can do this one.
Yeah, it's debit cash, credit sales.
So cash is an asset, and sales increase net income. So cash, yeah, assets are understated because we didn't record the cash. Nothing happens to our liabilities, and our sales were not included, so our net income is going to be understated. Good. Okay. Someone want to do number 36?
Can I try doing 36?
Yeah.
Of course.
So they incorrectly recorded it as debit to equipment and credit to accounts payable, when it should have been equipment debit and cash credit, right? And then, yeah, it's an asset, and then accounts payable, they increased, the liability was also increased. Okay. And then cash decreases as an asset. Okay.
Okay, so what's my answer?
For assets, is it overstated?
Yes. Why?
And because they increased it the first time, which was correct, and then the second time they forgot to decrease it, so it's being overstated.
Good.
And then liabilities, it's also overstated because they weren't supposed to. It wasn't supposed to affect liabilities, and then net income is not affected.
Good. Someone try number 37.
I had a question. Is he going to include both periodic and perpetual in the final?
I think just periodic.
Just periodic? Okay.
Just to let you know, guys, like there's not going to be like these last, like from 34 down, like these are really simple ones. Like the overs and unders that you're going to get on the final are going to be a lot more complicated.
One more question. On the practice quiz, we had to type in the answers like OON or whatever. Do you think if we get one of them wrong, will we still get a point? Or we'll get like a miss, like a no point for the entire question?
I have no idea how he's doing it.
So my executive sent out, I think it was his email or something about the details on your final exam. I didn't see anything about that guideline, but however, when we took our final, yeah, it was like that. If you missed 2 boxes, your whole entry was wrong.
But if you got one wrong, then you just got 2 points off instead of 6, right?
No, that was for the midterm.
But that wasn't online, right?
No, no, we had it last semester.
I feel like this online one is like we can get like no points for the entire question if we get one of them wrong.
Yeah. I will also like to like enforce to you guys that when you guys are practicing, make sure you guys include numbers, because on our final, he combined multiple scenarios with numbers, and we were like gonna like analyze like which account is being affected.
Yeah, you have to use numbers. Because he'll give you, like, which number is it? Like something like 26, where you have your assets increasing by 12 but decreasing by 11. So it's really still increasing by, or whatever, but you're gonna get numbers. So I definitely recommend just, and you can make up numbers as long as you know that it's like less than the other one. You can just do whatever you want, you know. Okay, 37. No one wants to do 37. Correct one should be debit purchases, credit to AP. Purchase debit, AP credit. Yes, that is correct. Purchases, AP. What kind of account is purchases? Or what does it affect? Does it increase it or decrease it? Why do you say increase? Purchases is an expense. So it's going to decrease it. And then what about accounts payable? What does it affect? Liabilities increase, yes. So let's do this. So what's the answer? Nothing happens to our assets because no account is affecting it. Our liabilities should have been increased, so they're understated, correct? And our purchases lower our net income, and that didn't happen yet, so our net income was overstated. Done. Okay, 38. Cash received from a customer in payment of the existing account is recorded by Alpha as if the receipt was for a current period sale. Can someone explain to me what happens?
Can we have Stanja do number 38?
Okay.
Yeah, you're right.
So they received cash and it was paid on an existing account that they have. So they debited to, they received cash and it brought down the AP. So cash increased and, sorry, not AP, AR. It was paid on AR. So, sorry, not AR, AP.
Wait, first tell me what they did wrong. What they do wrong?
So they recorded as a current period of sales.
So what's the journal entry?
Right. So the journal entry is they credit the sales and debit the cash.
What should they have done?
So they should have, the cash is still debited, but it was paid on the accounts payables that they have.
No, not account.
Account receivable, sorry.
Because they received cash, they're not paying cash.
Right. They paid on an account that the customer owed them, that they have with them. So the answer for that would be overstated in the assets.
Okay.
Nothing done with the liability. And they overstated on net income.
Good. That's not an asset.
Shouldn't sales, oh, yeah, there you go.
That's what happens when you go too fast. Okay, 39.
So Alpha recorded a credit sale as debit to cash and credit to sales. So what did they wrong here was they debited cash and they credited sales when they should have oh my god, I can't even talk. When they should have recorded it as a debit to AR and a credit to sales. Similar to the one that we had our dividends payable and accounts payable, there is a relationship with these journal entries. They're the same, right? Assets are increasing in both and net income is increasing in both. So yeah, it will be no effect for all three.
Last one.
40, so it says Alpha failed to record depreciation at the end of the current period. So at the end, they should have recorded it as a debit to a depreciation expense and the credit to accumulated depreciation. Depreciation expense decreases your net income. And since accumulated depreciation is a contra account to the assets, it will also be decreasing your assets. So we don't see liabilities here, so liabilities are no effect. Since they forgot to lower their assets, your assets will be overstated. And since they forgot to lower your net income will be overstated as well. Lania said, I have 2 questions that aren't from this worksheet. Can I read them out loud and maybe we can go over them together? Yeah, sure.
Maybe before we do that, does anyone have questions about the extra?
If you guys haven't yet, let me know if you're in BAP and just drop your CSUN email so we can send you the recording of this Zoom call.
And the notes that I'm taking.
Yeah.
But Lania, you can go ahead and I'll write them down too.
Okay, so this one is from the practice midterm he gave us since we didn't have a second midterm. It says Alpha failed to record 2 types of AGEs, a deferred revenue and an accrued revenue.
Is this a practice midterm from that you got from a student?
No, from him. He sent this out to us as a second midterm.
So they failed to record an adjusting journal entry for deferred revenue and
let me read it again. And accrued revenue. So deferred and accrued revenue.
Deferred and accrued revenue. You guys have 2, we practice midterm 2 exams. Okay, so what's the journal entry for deferred revenue? The adjusting journal entry for deferred revenue. So what is deferred revenue?
Revenue.
What?
Revenue.
Okay, deferred revenue is unearned revenue, right? So if we're doing an adjusting journal entry for that, then the adjusting journal entry is going to be a debit to unearned revenue and a credit to revenue, because that's how we adjust deferred revenue. And then what was the second one? Accrued revenue?
Yeah. Mm-hmm.
Oh, and then accrued revenue. Yeah, so accrued revenue is going to be something that you've earned but haven't been paid for yet. So you're going to debit AR and credit revenue. So in this case, we have our asset as AR, unearned as our liability, and then revenue. So this is the liability, and this is a liability, and when you debit it, it decreases. This increases net income. This increases your assets, and this increases your net income. So this was so our assets are going to be understated because we didn't increase our AR. And then our liabilities are going to be overstated because we didn't decrease our liability. And then our net income is going to be understated because we didn't include the revenue. Is that the right answer? I don't know if he gave you guys the
Yeah,
answer.
that's right. Yeah.
Makes sense.
And what's the
Thank
second?
you.
Yeah. And what's the second one?
The
I'm
second
sorry, you're
one,
doing extras from where? I didn't see this overs and unders.
The practice exams that professor gave you?
And that's in his website?
Yes.
he sent it out through email. It was like a replacement for the second midterm that we didn't have.
Yeah, that's fine if you guys have those, but we will not be going over any like midterms you got from other students because Dr. Weiss sent us an email that it's kind of unfortunate for people that are not here to kind of like learn from that. But if you have like midterms from like students, I'm gonna be sending you the email with the recording, and just email me or Ariana if you have any questions.
I only had that one question actually. I figured out the other one. Sorry, guys.
Okay, awesome, thank you.
Does anyone have any,
Can you explain why our assets were understated?
assets? Because AR should have been increased.
What about liabilities?
Unearned revenue is a liability and we debited it. And so that lowers it. So we didn't lower it. So it was overstated.
So when we do this part, we look at the part that what we did, not like we look at the wrong version, not the correct.
Well, nothing happened in this one. She said that just like they failed to record both of these, the adjusting journal entries for both of these things. So if neither of those things were done, we need to overs and unders are looking at what they either did wrong or didn't do. So if we did this journal entry, it would be NNN, right? Like nothing, everything would be correct. So you're looking at what they either did wrong or didn't do.
Okay.
And in this situation, what they did, this is whatever we need to do, right?
This is what you need to do. Okay. And this is saying what were the balances and the assets and liability and the income before you did this?
But what they did that they're supposed to do, but what they did instead of doing this.
Yeah. Someone has a question.
So I just want to know what they did and what they should have done.
They didn't do anything.
Oh, okay. I got you. Thank you.
They had to do this, but they didn't do anything before. It just said record adjusting journal entries for deferred revenue.
Oh, okay, got it. I just like joined you. That's why I did.
Oh, okay.
Sorry.
Yeah, no, it's okay. This is the adjusting journal entry for deferred revenue, and this is the adjusting journal entry for accrued revenue. That's what the question was.
For Henry's question, it kind of looks familiar to the ones we did.
That's number.
This is number 9.
Do you have any general strategies for taking the final? That's hard because I don't know how he's testing you guys online, but I know for our test.
How did you prepare for your final, I guess?
What did you say?
How did you prepare for your final? Like, you went over the handouts and like.
Went over all the handouts, and then I practiced a bunch of like multiple choice questions because on the final, the multiple choice questions are really important. They were it was like, what, 70% of the test? It was intense.
Yeah, it was like 60.
Yeah, but I think it's going to be a lot different for you guys, especially because you didn't have the second midterm and the finals online. But I think it's just really important to, like, I don't know. I think with me, like, I use a journal entry for absolutely everything to understand everything. If that doesn't work for you, then do T accounts to understand everything. I mean, you just got to find whatever works for you, but you really just got to think everything out. Like, things have to make sense, you know, like if I didn't include cash, my assets are understated. You know what I mean? Like, you just have to try to think of everything logically.
What I really enjoy about Dr. Weiss is that he has a heart. He knows that this is unfortunate that we had to like go this way. So I'm assuming he'll play some curve with you guys. But just absolutely just try your best on your final exam. Don't rely on cheating. I know you guys can't go back to your questions. Like, just make sure you go in as it was a regular exam. Because the more you focus on cheating, the more you focus on setting up Zoom calls with your friends, it's just gonna like mess you up.
Yeah.
And
I'm
did you
gonna
record this tutoring? Can we like watch one more time or?
Yeah, I'm recording this whole thing.
And where you're gonna post so we can
We'll
find
email it to you guys.
Oh, okay. Should we post our email?
Everyone post their email.
If you haven't, just place your email in the chat.
Okay. Oh, well, thank you so much.
Henry, let me answer your question. Let me find the question because we did it, right? Okay, Henry, it's right here. So they recorded a, yeah, okay, so if you look at number 21 on, no, that's wrong. Sorry, that's not the right question. Here. Okay, I'll just do it. Okay, so you said they recorded it as a debit to rent expense and credit to accounts payable for the full amount. Alpha used 10 months of the rent during the year and AG was not recorded at the end of the year. Okay, so basically what they did to start with is that they debited rent expense for the full amount and debited accounts payable for the full amount, which is wrong. How can you pay for all of the rent when you're not really paying it with cash, right? So what they did wrong was they debited rent expense and credited AP when they should have, if they want to do it this way, debit rent expense for the full amount and credit cash. You have to credit cash because you can't, you just can't use AP in this case. And so now they use 10 months of rent during the year. So if they expense the full amount, you have to unexpense 2 months of it because they only use 10 months of it, right? So you have to debit prepaid rent because now you have 2 months of prepaid rent that you still have, and then unexpense $2,000 of the rent expense. Not looking at the messages if he's saying something.
Which one are you doing? I'm sorry.
Henry posted something in the chat. I'm answering his question. So for this, let's talk about, so this decreases net income. Crediting AP increases your liability. This decreases your net income. This decreases your assets. This increases your assets. And this increases your net income because you're unexpensing it, right? So let's So for cash, it should have been credited by 12. Prepaid rent should have been debited by 2. AP should not have been credited by 12. Rent expense was debited by 12,000, which is fine. So that cancels out, right? And then we had to unexpense for 2. So in terms of assets, our cash should have gone down by 12 and increased by 2. So net should have been decreased by 10. So our assets are overstated. And then for AP, it should not have been increased by 12 because crediting our AP increases our liability. So liabilities are overstated. And then in terms of rent expense, the $12,000, that cancels out because that's fine that they did that. But now we have to unexpense it for 2,000, and unexpensing it brings net income up. So net income is going to be understated. Does that help, Henry? Okay.
Is this one of those unusual journal entries?
Yes. You never really credit rent expense unless you expense all of it and then need to unexpense it. Another question is, Alpha failed to record the journal entries for customers' return of merchandise for cash. Alpha uses the perpetual. Okay. So that one is, so we're using the perpetual inventory system, which means we have to use COGS and inventory. So they
they will like debit inventory and then credit COGS.
Well, what's the first one is a debit to sales RNA and a credit to cash. And then the inventory and the COGS. Right?
Mm-hmm.
So then in terms of the accounts, sales RNA is a contra revenue account. So this decreases net income if sales revenue increases net income. A credit to cash decreases your assets. A debit to inventory increases your assets. And COGS, a credit to COGS, because COGS is an expense account, a credit to it increases your net income. And we're going to use numbers in this case. So I'm going to say 1,000 because what it costs to make is not what we sell it for. So I'm going to use that. So now in terms of our accounts, we have cash, inventory, sales RNA, and COGS. So okay, so in terms of assets, this should have been decreased by 1,000 and then increased by 1,000. So net should have been decreased by 250. So our assets are overstated. Nothing happens to our liabilities in this case. And then in terms of net income, should have been lowered by 1,000, but then increased by 750. So net should have been lowered by 250, which means our net income is overstated. Is that good on that one? Anyone else have any questions? Yes.
It's going to be the same meeting ID and same people.
And are you gonna do the like handout 6 and then extras?
It's handout 4 and extras.
What is it?
It's handout 4 and extras for our meeting ID.
And I put my personal email. Is that okay?
Yes. I'm assuming it'll be fine because I'll be sending it out through my CSUN email.
And I accidentally say handout 6, but it's handout 4. So.
Wait, what happened?
I asked about handout 6, but that's my bad. So it's not handout 6, right? You're gonna do only overs and unders.
Yeah, handout 6 has a different meeting ID.
I have a question. Are you going to be sending out like the recording for this today, like after today's meeting, or do we have to wait until tomorrow?
I can send it right after. I mean, I just have a small meeting after this session, and I'm free to send it right after.
Oh, okay, cool. I just want to review it before tomorrow's meeting.
And then
You'll have it by 5 for sure.
Okay, perfect. Thank you.
And I'll send him my notes to send with you guys in the email too.
Thank you so much. Because I joined on a little bit later.
Yeah, of course. What's your question from handout 5? What is it? Is handout 5? Oh, is handout 5 the
Handout 5 is
balance?
It's a cash to accrual.
Oh, okay. What's the question?
So the question was, it's actually the practice midterm. It's not the handout 5, but similar to it. So handout 5, I noticed that when they add the account receivable to the sale, but on this one, they actually minused it. I just wanted to clarify that. I know you guys don't have all the information, but I could like describe you.
Wait, so you're saying that which account is being affected?
So the sale was $324,000, and account receivable for 2019 was 16,000, and 2018 was 26,000, and then unearned revenue for 2018 was 2,000, and for 2019 was 6,000. Now, from all of this, he only took into account for sale $310,000, and he minus the difference on the receivable and difference on the unearned revenue. I just wanted to understand why he minused it instead of adding it.
I don't know. I feel like I need to see it to understand.
Yeah, I feel like I need to see it too. Oh yeah, Anthony has a really good YouTube video. If you go on YouTube and Google CSUN 350, he has a video for handout 5. That's the formula we used for it.
All right, I'll do that. Thank you.
Yeah, and I believe Raymond is he's the other tutoring director. He's teaching handout 5, and he'll be also teaching it tomorrow at the same time.
All right, I'll reach out to him. Thank you.
Okay.
Does anyone else have any questions?
Yeah, actually, I just need to know like any clue, any advice about overs and unders, anything we need to know for like overall, not like specific question.
I mean, the way that I was taking notes, right? I did the journal entries and I did the T charts, and then we also did Jesus's little trick with putting if it's an asset that increases or decreases or whatever it affects, right? You don't have to do every single one of those things. You just have to figure out which one works best for you. I do journal entries. Jesus does journal entries, but most people do T charts, right? So it really just depends on what makes sense to you.
Okay, so actually I used to do like what they did, what I should have done, and then just like fill out the
I would do, yeah, what they did and what they should have done. I'd use different colors so you can tell the difference between the two. I always do red for what they did wrong and then black or blue for what they should have done. That really helps me.
yeah.
Sometimes just like literally using your hands and be like, oh, they increased, but they should have decreased, right? Like,
Yeah, I did the same thing.
yeah.
My daughter was laughing yesterday. I was doing like, Mom, are you dancing?
Yeah.
No, I'm finding.
Yeah, no, literally on like in Noski, like I will be doing this and I will look around and other people will be doing this. So like you're not the only one.
So I'm not the only crazy one here.
Yeah.
Thank you so much, guys. I joined like very late because I joined those two tutorings today. But I'm gonna join tomorrow early to just, I don't know, practice more. Thank you so much for what you do. Take care, and that's it for today. Thank you.
Bye. Anyone else have any questions?
Nope. Okay. Well, thank you guys. Good luck. If you have any questions, just email us. We'll be here tomorrow, same time, 12 to 4.
I'm gonna type in my email for everyone because you'll be getting an email from Jesus.
Yeah.
That's my email, I think. Hopefully.
I'll just like CC it to your email.
Okay. If anyone needs help, feel free to reach out or also just come tomorrow with questions. But if you're coming tomorrow, be prepared to participate because it's only going to help you.
Okay. Thank you guys.
Thank you. Should I end it?
Okay. I have to go to a meeting. I'm
Okay.
scared.
Thank you guys. Bye.
Bye. Thank you.
Thank you so much.